full this time, because last time I tried to do the stream on it and unfortunately it didn't quite work because I was doing it without actually being able to show you. And so this time I'm going to go in and actually show you everything properly and be completely honest and transparent about what I've been putting my money into for the past year and show you with examples how it's working for me. So one thing I want to say about this is that I've started doing this because I want to make my money work for me for the long term. This isn't taking away from all the things I still want to do in terms of travel and the experiences and memories I want to create. That still comes first, but I've decided to put some money away for the longer term, and then rather than just save it, I've decided to invest because that's the better long-term way that I see it working for me. I'm going to jump into it right now. I'm going to show you how my portfolio is set up, the different investments I have right now, and the different allocations between what I'm investing in. Now let's see if this works. So I've whipped together a little slide here, and this is Creative Money Mornings number 9. Good morning, Bert. Good morning, Chim Chim. Hello again. Hi, everyone. All right. So first, before we start, I just wanted to start by reading this comment because I got this morning and I really, really appreciate it. So thank you, Anthony. It said this was related to the investing video that I did on this channel, Investing for Beginners. And Anthony said, this video, believe it or not, changed my life. After finishing this video, my brain went into full gear about short and long-term investments. I've managed to select and pick some good stocks and build a dividend portfolio. And to think before the first week of May, which was only a month ago, I didn't know what the hell an ETF, dividend, or compounding was. So in short, thank you. And I just want to say again, thank you to you as well for leaving that comment, because that's why I do it. And that's like, it feels great as a video creator to receive feedback like that, because it really does mean a lot. And I'm glad that video could help and gave Anthony an insight into investing, and now from there he can go and learn even more. So that was a great thing to wake up to this morning. I just wanted to share it before we get started. So this is what I started saying at the beginning. For me, experience and memories are still so much more important to me than just having money in the bank. So that still comes first, and I always just saw money as a means to an end to do things that I really want to do. And I'd rather than just putting loads of money in the bank and have it as savings, I'd rather spend that on the here and now and getting to do things and travel and see parts of the world that I couldn't if I didn't have the money to be able to do that. So for me, experience definitely is more important than money. But I started thinking more recently over the last couple of years that if I have more of a security blanket and I have more money set aside for the future, that gives me more freedom to do what I want to do now. Because then I'm not necessarily that worried about where the money comes from in the next month or the next couple of months, because I know I still have that blanket, that safety cushion of a portfolio to have anyway, to have as a backup plan. And one of the main things I would say about investing is that you shouldn't plan to spend it. And if I'm putting money into the market, I'm planning to leave it there for the next 5 years. But just by building up a cushion and building up a safety net, it gives me more freedom to be able to do the things that I want to do, because at least I know I have that to fall back on if everything else went to rubbish, went to shit, you know. So it was always kind of said to me, when I was younger, especially, that, are you going to travel or are you going to save money, you know? Like, not in exactly those words, but like it was always the idea of you can either save or you can go and spend all your money on travel. And you can either have a secure job or you can just go away backpacking. And I don't really see them as that mutually exclusive anymore. I think that these days you can do both. You can work online and you can travel and you can see things and you can go and do all these experiences, and you can also save or build up an investment portfolio as well. And I'm using save in a loose term because I don't mean just putting it in a savings account. I mean just saving for the future and making your money work for you through investments. So I think these days you can do both, and that's what I'm trying to do, and that's what I'm trying to help show other people how they can do the same. So the thing is with investing, and a lot of people have jumped into it over the last couple of months, imagining they can time the market and consistently beat the market. But over the long term, it's the time in the market that counts rather than timing the market. And this has been proved true by so many people over so long that it would just be arrogant to think that you can time the market as an average investor rather than just spending more time in the market. And the idea of this is basically, as long as you're keeping your money in the market and you're keeping your money in investments over the long term, it will always trend up. And this has been my philosophy over the last couple of years while I've been slowly buying in, rather than trying to buy in at a certain point and then sell when it peaks and then buy back in on the dips. Over the long term, you will miss out that way. And before I show you my whole portfolio, which I'm 100% going to do in a second, I just want to try and explain that because this is core to what I believe. So the best strategy always over the last 30 years is dollar cost averaging. And that's what DCA stands for. And it basically means buying in every month or buying in over a certain time period consistently. It's usually every month. So if you just dollar cost averaged every month since 1980, that is what your portfolio would look like. If you, and that's the black line going along there. If you bought the dip every time, so if you bought every time there was a major dip and you bought in there, you would think that that would be the best way to play the market, because this is if you bought the dip perfectly. But you'd still underperform dollar cost averaging over the last 30 years. And that's, I mean, that is amazing graphic to see, because buying the dip, even though you think that would be the perfect strategy and it is almost impossible to do it perfectly, dollar cost averaging still beats it over the long term. And let me just switch off my video so you can see this properly. So this is the problem with market timing, that when you try and buy in and buy on the dips or buy on the peaks, or well, obviously buying on the peaks would be a bad idea, but if you try and always buy on the dips, then often you still miss out on some of the great trading days. And as you can see in this here, if you miss out on just 5 trading days, you lose 40% of your portfolio over 20 years. This is from 94 to 2013. If you missed out on 40 days of the biggest gains, so the days with the biggest gains are usually after the biggest drops. If you miss out on 40 of them, you'd be way down on your portfolio. And I'll leave this here, or you can pause it and have a look at it later, but it's a really good graphic to show you why dollar cost averaging still works better than trying to time the market. And so that's what I've been doing over the last couple years, is just dollar cost averaging into various funds that track the market. And that was sort of the strategy that I got told to. Well, let me put my video back on. One sec. So that was sort of the strategy that I got told to, just dollar cost average in and buy into funds and buy into funds that track the market. So over the long term, you still get the returns as the market goes up. That's what I've been doing over the last couple of years, and it worked fairly okay with me up until a point. And it still will work over the long term, and I'm still keeping my money in over the long term. But in the middle term, as in for the next few years, maybe there could be a better opportunity to reallocate away from just buying these index funds that work great in a big bull market where everything's going up. There could be a better opportunity to reallocate into more individual investments, which is what I've decided to do. So although I'm still leaving my money in the market because I'm not trying to time it and take everything out, I am instead reallocating, and I have reallocated over the past month or so, into what I think personally will do well over the next few years. And that's what I'm going to share with you now. So that's a bit of background on why I've invested in what I have and what I'm going to show you now, just so you have a bit of a basis of understanding for it. And now I'll go into it. So the world is changing constantly, but over the last couple months, it's probably accelerated things that were happening anyway. And that's what I've based this on, that we are quite probably in a recession or heading to a depression. And because of that, you have to change your approach towards investing. And this isn't me just saying that. I'm not trying to present it as an expert. This is me um, collecting information from a lot of different experts and reading and podcasts and videos and deciding that I agree with all of those people. So tracking the index in this kind of new normal that we have probably won't work, because although we've had a massive recovery over the last month, it's then likely to go down and go up again and go down and go up again. And they generally call that going sideways. So you can't just set your money into an index, into like a UK market and forget about it, because that may not work. It may work, but you're unlikely to get consistent 5-10% each year just from doing that. It seems very unlikely looking at the world the way it is right now. So instead, as I said, that's why I decided to reallocate. And this is how I've decided to break it down right now. This is how my portfolio looks right now. And being completely honest and transparent, this is currently £20,000 or thereabouts, split between these allocations. And although that's a modest amount right now, I think there's I'm still proud of it, because I've managed to travel over the last couple of years and do the things I want to do at the same time as putting away some money and building up a bit of a portfolio. So this is how I've broken it up. And right now, I'm actually, once I started compiling this morning, I decided I'm going to change these allocations slightly, but from what I just collected, all of the information, this is how it's broken up right now. So I've got 10% in gold, and I started saying why in yesterday's video, and I'm going to go more into that in a minute. I've got 23% in disruptive tech stocks. So whenever there's a massive change in the world, whenever there's a massive disruption, it's usually there's some tech companies that come out of it very well, and I've decided to position myself towards that. 12% in crypto, which is basically Bitcoin. I have very little in anything else. I'm mostly in Bitcoin right now. 15% in cash that I'm holding, just waiting for another opportunity possibly, and then 40% still in funds or trusts, because I don't personally want to keep buying and selling all of the time. I'd rather put my money into something that can be actively managed for me, and so I've still got a decent amount of my portfolio in funds and trusts that I think will do well. So I'm going to break it down even further after this. So this is my current Hargreaves Lansdown, which is what I use to invest. This is my current portfolio with them. And I'm going to show you each of these companies in a second, very briefly. It would take far too long to go into a full breakdown on every company, but I'm going to tell you a little bit about each of them. I'll just leave that there for a second. I'll take my video off so you can see the last one. The last one is Wisdom Tree Physical Gold. So, Illumina, let's go into it. So you see I'm doing okay with this. I did reallocate maybe the end of March. So I moved from just having a bunch of index funds into more of these individual companies and opportunities. And some of them have performed well since then. So from the end of March, you can see one's up 55%, 30%, 40%, and varying degrees of success below it. But I'm okay with that. I'm happy with that. So Illumina is a disruptive tech stock based in the US, and it's a genetic sequencing and editing company. Now, we're in a new world where genetic sequencing and possibly genetic editing is becoming more and more acceptable. Where 20 years ago, or maybe 10 years ago, it wasn't possible. But 20 years ago, it wasn't possible. But let's say 10 years ago, it was massively taboo, and people wouldn't even consider it. It would be against God. These days, it's becoming more and more acceptable. And it does seem that now we are possibly moving into a world where people would like to have their genes. I mean, lots of people having their genes sequenced already, and finding out what genes they're missing and where their vulnerabilities are. But some people also investigating how they can edit their genes. For example, in China, they've already had a couple of babies called the CRISPR babies that have had genes edited and are basically designer babies. which I mean, sure, you can stand differently on it ethically, but we won't get into that. But this is a massive disruptive company and disruptive opportunity that possibly has a part to play in the next 5-10 years. So Illumina has 70% market share of the sequencing technology. They produce all the technology, and they have 90% market share of the data of all the gene sequencing data, which is insane. So if you're interested in gene sequencing, if you're interested in that type of company, then Illumina looks like they probably have the biggest exposure to it. And again, it's not just me. Go and do your own research, watch other videos for it, but that's why I've decided to have a look at it. Or not even have a look at it, but decided to invest in it. But as always, do your own research. Go away. These are just ideas, just for entertainment purposes. Always go away, take the name, go have a search, and decide for yourself. So ITM Power is based in the UK. It's another disruptive tech stock, and it's based in the hydrogen energy and storage section of the market. I think after this, and this is my personal opinion, that we are moving towards a much bigger green economy. I think there is likely to be higher taxes on traditional non-renewable energy, and hydrogen is possibly a solution to that for the future. And it's not just me that has again, like, none of these are original ideas. This is multiple recommendations from different magazines and newspapers and videos and stock buy recommendations. And I got into this a few weeks ago, and since then it's almost doubled. So like I showed at the beginning, it's up 55%. It's still very early in its life, but again, do your own research. And this is likely for me to be more of a longer term buy and hold, as all of these are. But I'm just giving you a quick breakdown of what they are, and then go away and search it afterwards. Illumina, cool DNA genetics companies. I want to get some of that, and also Seattle Genetics. They're a bit expensive now, though. Didn't know they did. Yeah. Definitely have a look at Illumina for it. They are probably the biggest company in it, but they're still quite probably undervalued. They've gone under the radar quite a bit, but definitely. I mean, let's say under the radar. They're known in investing, but they're not known as like a household name or a big company, which they could be in the future. So Wisdom Tree, and this is physical gold, and I outlined some of my reasons for gold in a previous video, but basically gold is a hedge against the stock market, and it's a hedge if you think we're going into economic turmoil, if you think the dollar is going to be devalued, if you think that if inflation is likely, or basically if you think that the world is in a bad place right now, and I mean, looking at a lot of evidence, it quite probably is, then they say you should have some portion in gold as a hedge against that. So I bought into some physical gold a while ago, and as I said at the beginning of this, I was looking at where I could reallocate. Well, physical gold is one of the places I'll be looking to dollar cost average more into over the next couple of years, because I don't see, it doesn't have a huge downside, but it does potentially have a large upside. Now, this is holding gold in an ETF, because rather than me just buying a big lump of gold, and having it in my drawer, this is an easy way to get exposed to owning gold. As always, do your own research. You see, that's a theme on each of these. And then further to a gold play is if you want to be more exposed to gold, as in you think gold price is going up, but I mean, if gold price goes up, let's say it will only go up 5%, 10%, maybe more each year. So if you want to be more exposed to it, a way to kind of leverage that is to get into miners. And so I bought into this 91 Global Gold, which is a gold and silvers miners ETF. And I dollar cost averaged into that for the past year and a half, and again, that was one that was up about 40%. I'm still averaging into that each month. Right now I'm putting like a couple £100 into this each month, because I still think personally that gold has a long way to go. And again, it's a hedge against the stock market, and again, a hedge against the world doing well, I guess. Again, do your own research. And Tesla is like the internet's baby right now. Everyone loves Elon Musk. Everyone seems to be all over Tesla right now. But I think it's for a good reason, personally. Tesla is something I looked at even, years and years ago. Before I even started traveling, I was looking at Tesla personally back in like 2015, when it was around $50 a stock. And everyone has those sort of stories, but God, I wish I'd bought it then. But I still kept Tesla on my radar because I loved Elon Musk with what he did with PayPal and then starting SpaceX and Tesla. And I just kept an eye on it for quite a while, but I always thought it was quite overpriced for what it is. And I think it's probably still quite overpriced. I think it's trading at something like 100 times its projected earnings for next year, which is crazy. But it is a disruptive tech stock company, so they are usually overvalued in that way. And I've now had an opportunity to buy into Tesla because it crashed during the whole financial crash in March. It crashed from $900 down to around $300. So I bought a few Tesla shares, like around 480 maybe. And it was a good time to get in. Would I buy it now? Probably not, but now that I have bought in, I'm just going to hold that for the longer term. And I put in the green economy here because, like I said, I think more people will be going to electric cars. They're not going to lose out in this whole situation. More and more people are looking towards becoming greener, and Tesla's well positioned for that. And also, I put confirmation bias on here because, with how Tesla is and the amount of people jumping into the stock market right now, it is kind of seen as that poster child for the stock market. And because more and more people are getting exposed to it, I think more and more people are jumping in and just buying Tesla. So that could be a sign that it's in a bit of a bubble and it probably is overvalued. So it's probably got a way to come down, but who knows when that happens. So for right now, I'm just holding it because over the long term, let's say 5-10 years, I still believe in it fundamentally. Scottish Mortgage Investment Trust. Now this is a fund because I said I would like to just have passive investments that are actively managed for me by other people. It's actually a trust. It's set up as a trust, but it works as a fund. They invest into a bunch of different companies and look for value where there is value. Now they're heavily exposed to tech stocks right now that have been performing well over the last couple of years, and for me this is just a buy and hold. They've traditionally done very well. It's one of the best funds or trusts out there that you could buy right now from everyone's recommendations, but this is where you're going to see that I'm not very well diversified right now, let's say, because as you can see here, they're actually also heavily invested in Tesla, Illumina, and tech companies within the US and China. And that is a large portion of my portfolio, these sort of tech companies that I think could do quite well in the world we're in. They're still massively valuing Amazon. 9.5% of their investment is into Amazon, and Amazon is trading at a crazy amount. And everyone keeps saying Amazon's overvalued, but then it keeps going higher and higher. And the same with Tesla. So, and then Illumina. Actually, I didn't even realize they were invested in Illumina until I started making these slides this morning. But yeah, it's definitely worth looking at, Scottish Mortgage Investment Trust. And if you're not actively looking to buy and sell and manage your own portfolio, well, these guys could be a good passive way of getting exposed to this. So next, I did a video yesterday and another video besides this live on the nutmeg and how you can get into nutmeg. I again started buying into nutmeg and averaging into it about a year ago. And it's an easy way of getting someone else to manage your money for you. I don't have to do anything actively to do it. You basically just create a little pot on there. They call it a cash pot or they call it a pot. Say what you're saving for, what your level of risk is, and then they'll work for you. Over the last month, they did 9.5% on that pot I created. And then I also have a LISA, which is why I started using them initially. If you're in the UK, a LISA basically gives you 25% on top of your investment up to £4,000 a year. So let's say if I put £1,000 in, the government gives me 250 quid on top of that as an incentive for saving either towards retirement or saving towards your first house up to 450 grand. And for me, that just seemed like free money. I was like, hey, I'm going to get 25% on top anyway, and then I'll still be exposed to stocks and shares in their fund, and then maybe make an even bigger percentage on that. So although that says 5,200, I actually invested around 4,000 from that because it was the 25% on top. No brainer to me. I don't know yet whether I'll use that on my first house, probably as like some investment opportunity further down the line, or I'll just keep it there for later for when I'm 60, I don't know. But for right now, it just seemed a good way to save money. Then I said again yesterday about my crypto story, if you want to go back and watch that, how I lost like 8 grand in crypto in the last couple years. But this is what I've got left in it, and this is what I've built up to a sort of position right now. So someone mentioned yesterday, actually, it was a great recommendation by someone. First, let me go through it. So I've got the Bitcoin in there. I've got like, it was around $3,000. It's dipped a little bit because no, I mean, was it around? No, I got that slightly wrong. Sorry. When the USD price of Bitcoin was above 10,000. I think it was 10,500 last week. That was around $2,800. Now it's a bit down, but yeah, it's that's what I've got in Bitcoin right now as kind of like a spec play. But yeah, I mean, I'm just going to leave it there for again the next 5 years, dollar cost average in with the money that I'm earning from Hive, Steemit, Libre, Brave browser. And yeah, I'll cover them more in the future, but all of this that I've got in crypto right now, I didn't put in myself. It's all been earned through the crypto social media. And I started saying there, but someone mentioned in yesterday's live stream about Hedera Hashgraph, which is the H bar. And that's why I started a position in it now, because it was a great tip. I went and looked it after. Makes complete sense. Go and search it afterwards. H bar or Hedera Hashgraph. It's a cryptocurrency that is basically, it's backed or part owned by huge companies like Google. I think, well, let me go and search it now. Hedera Hashgraph. I can show you rather than saying it what's not completely true. So yeah, it's owned and operated by the world's leading organizations. So Google, Deutsche Telekom, LG, Boeing. It's got all of these big companies behind it, and that's what sort of piqued my interest on it. And they're kind of where Facebook was trying to do Libre. They've stepped in instead of Facebook, instead of Libre, and they're like the answer to that. So that's, well, it's just interesting anyway. I started that, although it's only $50, it's nothing right now. I just started that because I wanted to keep an eye on it. And further in this, I also just wanted to mention Celsius, if anyone is interested in crypto at all. It's a way of holding your coins or holding your cryptocurrency. So I'm holding my Bitcoin in my Celsius wallet, which then actually gives me interest on the Bitcoin. So I'm getting 5% interest on the Bitcoin I'm holding in the Celsius wallet. So even regardless of whether the price goes up or down, I get 5% interest. I only started that a couple of weeks ago, maybe $12 for nothing. So if I leave that over the long term, that interest will compound as well. And if it was a larger amount, you'll get compounding interest on your Bitcoin, which goes up in value, and then this will compound, and then you'll compound on top of that, if that makes sense. I'm going to cover it more in another video, but I just thought it was interesting. And lastly, I'm trying to build up also a position in cash for myself, because in a recession, cash is king. There will be, we saw 2 months ago that there was massive buying opportunities, and I maxed out everything. I just put everything in at that point pretty much, which yeah, maybe isn't wise over the long term, but I took a punt. I put all my cash into the stock market right then. It paid off. But right now I'm building up a cash position again, taking profits, because there will always be buying opportunities and investment opportunities in any recession. Cash is always king. So if you have cash set aside, then you can look at opportunities to buy. So yeah, that is it. That's what I've got 20 grand in right now. And if you're a seasoned investor, you might be like, well, that's not a lot right now. But hey, if I keep adding £500 a month to that at 10% per year, following compound interest, well, in 20 years, that'll be £530,000 from where I am now to just making 10% per year. And from this portfolio that I've created, and if I keep evaluating it and keep staying up to date with the market, I aim to outperform that 10% a year. And over the long term, that's what I want to do. But right now, if I can make 10% a year, that's great. That's traditionally amazing, and that's traditionally great. You've massively outperformed the market, so that would be really, really good. But of course, why aim for that? I'm going to aim a lot higher. But even if I can make 10% a year, that'd be 500 grand. And I say to anyone, go and check out compound interest calculators. This is how it's broken down here. So this was based on 20 grand right now, 10% yearly with 20 years, and then it compounds monthly with £500 going in each month. So that's if I only put in £500, which I'm already doing, and continue that for the next 20 years, it would end up as 500 grand. So that would bring me through to when I'm about 50. Now let's be more conservative and say I can make 5% per year, but then do it over 30 years with only putting £500 in a month. So this takes me through to when I'm 60, then it would be 500 grand still. But that's assuming that I only make 5%. And I mean, yeah, I'm going to have to constantly reevaluate and constantly learn and keep learning and keep applying those lessons. But I would plan to make, everyone would plan to, but I would hope to beat an interest of only 5% per year. But let's say I increase my deposits by 5% each month as I plan to earn more money in the future, and then I manage to make 10% per year over 30 years through to when I'm 60. So this is starting with 500 quid and then increasing that 500 quid by 5% each year. That would end up over 30 years as over 2 million. And that's the power of compound interest or compound investing. As long as you're continually dollar cost averaging in, and as long as you're continually learning and continually applying those lessons to make your portfolio better, and as long as you keep buying in and keep getting that return, then it just compounds further and further, and it eventually reaches crazy numbers. But if you're interested in investing, you might know that already. That's what got me involved with it, and that's why I started doing this. Yeah, Facebook Libre never got past, go through some comments now. Julian. Yeah, Facebook Libre never passed the regulators. Hedera Hashgraphs have worked with the regulators from the beginning. Also, Facebook Libre was trying to be a digital currency. HH is trying to be the, and then it cut off. Oh, sorry, it cut the trust layer of the web. Its tech is unbelievable as well. 10,000 transactions per second, a second before throttling, and 0.00001 cent a transaction. Your portfolio is 90% HBAR. Don't know anything for sure, but seems massively undervalued. Yeah, that's massively interesting. So thanks, Julian, for that tip. I definitely looked into it, and I am going to be building more into it in the future. To be honest, I just don't know enough about it yet. I started reading it. I started reading that, but it was only yesterday, so I just started buying a bit into it so I can actually track it and have some skin in the game and learn more about it. It is interesting. It's definitely, if I go back to this here, just while we're on that topic, this is what you were talking about here. The 10,000 transactions per second compared to Bitcoins and Ethereums, and they're touting themselves as the third gen public ledger. And then, yeah. So it's difficult to know who are the big winners out of all of this in this kind of space where it is so speculative. But to have a little bit of money in something speculative like this, well, why not? It's like it's the same as Bitcoin, really. I mean, and I'm not saying HH or Hedera Hashgraph is the same as Bitcoin. What I mean is the massive upside is potentially the same as Bitcoin, because you've got this investment you can make that can potentially go 10 times, 100 times, 1,000 times, and the HH is only at 4 cents right now, I think. And I'm not sure exactly what the market cap is, but I assume it's not very large. And so if you've got, I mean, sure, your money could go to zero. That's always a possibility. But if you have massive upside, then why not be slightly speculative with it and put in a little bit of amount, as long as you're prepared for it to go to zero. Yes, market cap's 194 million, which is 20,000 Bitcoin is nothing huge. I was just showing you there. Yeah, so again, this is interesting. This is another great site to go and search these things on, Coin Market Cap, and then you can. It's basically a way of tracking the market in crypto, the same way you would do with stocks and shares, but just within crypto itself. Yeah, interesting. I hope that helps people. Just going through more of the comments. I use Binance for my crypto. Would Celsius be better then? So Celsius is more of a wallet, and the way I understand it is Celsius uses your crypto to loan out for other people. So basically it sees itself as kind of a bank. You hold your cryptocurrency in Celsius, and then they're going to use that capital to create loans for other people, which pays you interest for holding it with them. So it's not an exchange, whereas Binance is an exchange. So on Binance, you have the risk of keeping your money in an exchange. What if that exchange gets hacked and people take away all of your cryptocurrency? And that's the same risk with Celsius as well. What if Celsius gets hacked, or the people that created the company just do a BitConnect and run away with all of your money? That's the inherent risk with crypto, because it's largely, it's completely unregulated. So like these companies could always run away with your cash or with your cryptocurrency. And with Binance, you have the risk to hackers. I know that's massively generalized, but like that is people's fear of cryptocurrency, is where do I hold it so someone can't just steal it and run off with it. And that's a real risk, to be honest, because it's happened to plenty of people. So I think the best way is to have it split between different things. If you have a large amount in it, then you should also have the offline wallet, like the Nano Ledger, and they say just keep that somewhere hidden in a drawer or something. And then also have it in a desktop wallet or have it in the exchange, and just diversify your risk even, rather than putting all your eggs in one basket. But the core to that is that Binance is a exchange, whereas Celsius is more like a wallet. Bear in mind, only 8% of HBAS released so far has slow release of coins to stop a 34% attack. Okay, so they're still slowly releasing it. So, okay, interesting. Yeah, I hope that helps people. I'm going to try and do this periodically and give you a insight into what I'm doing. Hopefully over in next year or whenever I do this again, that amount will increase. And I've tried to set it up so it is not an all-weather portfolio, but I tried to set it up so it maximizes the opportunity that we have right now, but yet I'm still overall predicting that we're going to have a lot more economic trouble before things get massively better, and that's generally my outlook. But trying to still invest anyway in the short term, and trying to still not in the short term, trying to still invest anyway and be set up for the longer term, if that makes sense. Yeah, thanks guys. Like I said at the beginning, those comments help, and I massively appreciate it. So receiving that comment that I showed you at the beginning was great, because it does show that this is making an impact, and it makes me want to push on and create more content. So if you are enjoying it, again, then let me know in the comments. If you're watching this either after the live stream, then leave a comment on the YouTube bit, and like and subscribe and all of that stuff. Thanks again. Have a good Sunday. I'm glad it was informative. Ben, thanks for watching. Sam and Chim, thanks for watching everyone, and thank you for your input. I'll see you